On January 27, 2026, the US dollar's share of global foreign exchange reserves hit 56.32%. That's the lowest level in 31 years. Not since 1994 has the world's dominant currency controlled such a small piece of the international monetary system. And here's what should terrify you. This isn't a temporary dip. This is stage 6 of an 8-stage collapse pattern that has destroyed every reserve currency in history. The Portuguese real, the Dutch guilder, the British pound, all followed the same sequence. All thought they were different. All collapsed anyway. The dollar isn't dying tomorrow, but the mechanism that made America a superpower, the ability to print unlimited money and have the world absorb it, that's ending. And when it ends, everything changes. Not gradually, violently. Let me show you exactly what happens after the dollar loses control. Not speculation about some distant future. The mathematical certainty of what comes next, based on 3 centuries of reserve currency failures. Because understanding the pattern isn't about predicting the future, it's about recognizing we're already living through it. The dollar's reserve status isn't collapsing because of a crisis, it's collapsing because of success. For 80 years, America has exported dollars to the world. The world needed those dollars to buy oil, to trade with each other, to store wealth. Every central bank held dollars. Every commodity was priced in dollars. Every international contract settled in dollars. This created the ultimate privilege. America could print money, buy real goods from other countries, and those countries would accept the dollars and hold them as reserves. It was the greatest wealth transfer mechanism in history. Print paper, receive products. But that mechanism had a hidden cost. Every dollar America exported was a liability, a promise. And America made too many promises. The national debt is $38 trillion. Unfunded liabilities for Social Security and Medicare exceed $200 trillion. The Federal Reserve's balance sheet is $7 trillion. These aren't just big numbers, they're structural impossibilities. There is no scenario where these obligations get paid in full value dollars. Everyone knows this. Central banks know it. Foreign governments know it. That's why the dollar's share of reserves has fallen from 71% in 1999 to 56.32% today. That's a 15 percentage point decline over 25 years. And the decline is accelerating. In just the second quarter of 2025, the dollar's share fell 1.47 percentage points, the fastest quarterly decline in a decade. But here's the critical insight most analysts miss. This isn't China attacking the dollar. This isn't Russia weaponizing alternatives. This is portfolio diversification by central banks that see the math and understand what's coming. They're not trying to destroy the dollar. They're trying to survive its inevitable devaluation. Now let me show you what happens when a reserve currency loses dominance. Because this has happened before, 3 times in 400 years. And every time the same pattern played out, stage by stage, year by year, until the old order collapsed and something new emerged. The British pound was the world's reserve currency from 1815 to 1944. At its peak in 1913, the pound accounted for 65% of global reserves. British goods dominated world trade. British banks financed global commerce. The pound was literally as good as gold because Britain guaranteed convertibility. Then came World War I. Britain borrowed massively from America to finance the war. By 1918, Britain owed America billions. The creditor had become the debtor. Britain tried to restore the pound's gold parity in 1925, but the currency was overvalued. British exports became uncompetitive. The Great Depression forced Britain off gold in 1931. The pound devalued 25% overnight. By 1944, the Bretton Woods Conference formalized what everyone already knew. The dollar had replaced the pound as the world's reserve currency. Britain had fought and won 2 world wars, but the financial cost destroyed the empire. The pound went from 65% of reserves to less than 10% by 1975. The transition took 30 years from World War I to Bretton Woods. But Britain started the decline as the world's largest economy and ended it barely able to feed its own people. The loss of reserve currency status didn't cause Britain's decline. It was Britain's decline. The currency reflected the reality that Britain could no longer produce enough to justify its monetary promises. And here's what happened to British citizens. Living standards fell 40% from 1945 to 1975. Rationing continued years after the war ended. Bread was rationed until 1948, meat until 1954. The British Empire dissolved. India, Africa, the Middle East, all gone. And Britain, which had ruled a quarter of the world, became a regional European power dependent on American protection. This is what reserve currency loss looks like. Not theoretical economics. Real decline in living standards, real loss of geopolitical power, real structural adjustment that takes generations. Now, let's look at what's happening right now with the dollar. As of early February 2026, the mechanics of dollar decline are visible across multiple systems. Foreign holdings of U.S. Treasuries have fallen from 50% of total issuance in 2008 to 30% in 2025. That's a 20 percentage point drop in ownership. Foreign central banks aren't buying new treasuries at the rate the U.S. government is issuing them. China has cut treasury holdings from 1.3 trillion in 2013 to 800 billion in late 2025. That's a 38% reduction over 12 years. Japan, still the largest foreign holder, owns 1.1 trillion, but that's down from 1.4 trillion in 2014. These aren't small adjustments. These are strategic repositionings. And here's where it gets really interesting. Central banks aren't just selling dollars, they're buying gold. In 2022, central banks bought 1,136 tons of gold. In 2023, 1,137 tons. In 2024, over 1,000 tons. 3 consecutive years of 1,000-plus ton purchases. That's the highest sustained buying since the 1970s, right before the collapse of Bretton Woods. Who's buying? China, Russia, Turkey, India, Poland, Singapore. These aren't small economies. These are major players. And they're converting dollar reserves into gold at record rates because gold can't be frozen, can't be sanctioned, can't be printed. Simultaneously, alternative payment systems are scaling. China's cross-border interbank payment system, CIPS, processed 27 trillion in transactions in 2023. That's up from 12 trillion in 2020, more than doubled in 3 years. CIPS now connects over 1,400 financial institutions in 110 countries. It settles in Yuan. This is a direct alternative to dollar SWIFT transactions. And the petrodollar monopoly, the arrangement that forced the world to hold dollars to buy oil, that's breaking. In March 2023, Saudi Arabia announced it would accept Chinese yuan for oil sales to China. This ended the 50-year petrodollar monopoly, not immediately, but structurally. Once the monopoly breaks, the advantage disappears. Other countries followed. The UAE accepts yuan. Russia sells in rubles and yuan. Iran sells in yuan. The petrodollar isn't dead, but it's no longer a monopoly. And monopoly privileges don't work at 70% market share. They only work at 95% plus. Now, here's what most people get wrong about this process. They think dollar collapse means the dollar disappears. It doesn't. The pound didn't disappear. It still exists. Britain still uses it, but it went from controlling 65% of global reserves to 4%. The dollar will follow the same path. It won't go to zero. It'll go from 56% today to perhaps 35 to 40% by 2035. Still significant, still widely used, but no longer dominant, no longer hegemonic. And that difference, from hegemony to just another major currency, that difference destroys the American economic model. Because the American model depends on printing dollars and having the world absorb them. When the world stops absorbing dollars at the current rate, America faces a crisis. Let me show you the mechanics. Right now, America runs a trade deficit of 800 billion annually. We import 800 billion more than we export. We pay for those imports with dollars. Those dollars flow to China, to Europe, to oil producers. And they hold those dollars as reserves or invest them back into U.S. Treasuries. This allows America to keep importing without adjusting. But when foreign demand for dollars and treasuries falls, this loop breaks. We still want to import. They still want to export.
Oh
They
my
don't want
God.
our dollars at the same rate. So either we export more to balance the trade, or the dollar devalues to make our exports competitive and their goods expensive. Most likely, both happen. The dollar falls 30 to 40% against other currencies over 5 to 10 years. American exports become competitive again. But imports become expensive. Oil doubles in dollar terms. Electronics double. Everything Americans buy from abroad becomes 50 to 100% more expensive. This is the standard of living adjustment. Americans have lived beyond their productive means for decades by printing dollars the world wanted. When that ends, living standards fall to match actual productivity. Based on the British experience, that's a 30 to 40% decline over 10 to 20 years. But it's not just imports. The US government borrows $2 trillion per year. Who buys that debt? Partially foreigners, partially the Federal Reserve, partially domestic institutions. When foreign buying drops, someone else has to fill the gap. The Fed can print money to buy Treasuries, but that's inflation. Or domestic institutions buy more, but that crowds out private investment. Or interest rates rise to attract buyers. Or the government cuts spending dramatically. Every option is painful. The most likely path is what Britain did. Some of everything. Some inflation, some spending cuts, some tax increases, some borrowing at higher rates, and slow structural decline over decades. Not a single crisis moment. A grinding adjustment where each year is slightly worse than the last. Now, let me show you who wins and who loses in this transition. China is positioning to win. They've spent 15 years building alternatives, CIPS for payments, Yuan swap lines with 40 countries, Belt and road infrastructure creating Yuan-based trade, and massive gold reserves, officially 2,298 tons, likely over 4,000 tons, including unreported holdings. China is building the infrastructure for a Yuan-based trading bloc in Asia. Oil producers win by diversifying. Saudi Arabia joining BRICS in 2024 was a signal. They're hedging, still selling oil in dollars, but also accepting Yuan, also accumulating gold. Also building relationships with China and Russia. When the dollar falls, they won't be trapped. Gold holders win massively. Central banks buying 1,000 plus tons per year are creating sustained demand. When the dollar loses another 10 percentage points of reserve share, where does that money go? Some to yuan, some to euros. But a lot goes to gold. Current price is around 2,950 per ounce as of early February 2026. Analysts are projecting 4,000 by mid-2026 based on current demand. But if reserve diversification accelerates, 6,000 to 8,000 over the next 5 years is realistic. Europe muddles through. The euro is the second reserve currency at 21% of global reserves. It benefits from dollar decline, but Europe has its own problems. Aging population, energy dependence, weak growth. The euro gains market share but doesn't become the new hegemon. It's a regional currency that becomes slightly more global. Who loses? American citizens who hold dollar-denominated assets. Your 401k is mostly in US stocks and bonds. When the dollar falls 40% against other currencies, your purchasing power for anything international drops 40%. Your stocks might maintain dollar value, but dollar value decreases globally. American workers lose through inflation. Import prices rising 50 to 100% means everything costs more. Food, energy, consumer goods. Wages won't keep pace. Real wages fall. The US government loses the ability to run unlimited deficits. Right now, the government borrows $2 trillion per year and pays $1 trillion in interest. When foreign buying drops and rates rise, interest costs could hit $2 trillion annually. That's more than defense spending. Something has to give. Either massive spending cuts, or money printing that causes inflation, or tax increases that slow growth. Now let me show you the timeline based on historical patterns. Britain's pound lost reserve status over 30 years, 1914 to 1944. But Britain also fought 2 world wars and faced unique crises. The dollar's decline will be both slower and faster in different ways. Slower because the US economy is still the largest and most productive. Faster because modern finance moves at digital speed. My projection, based on current trends. 2026 to 2030 sees continued gradual decline. Dollar share of reserves falls from 56% to 50%. This is the psychological threshold. Once the dollar drops below half of global reserves, the narrative changes from dominant currency losing share to multipolar currency system. That shift in perception accelerates the trend. 2030 to 2035 sees acceleration. The 50% threshold breaks confidence. More countries diversify. Trade increasingly settles in local currencies or yuan. Dollar share falls to 40%. This is when Americans feel real economic pain. Import inflation, rising interest rates, government funding crises. 2035 to 2040 is the new steady state. The dollar stabilizes at 35 to 40% of reserves. Still the largest single currency, but no longer hegemonic. The yuan is at 25%, euro at 20%, gold and others at 15 to 20%. A true multipolar currency world. The United States remains a major economy, but not the hyperpower. More like Britain after 1950. Important, influential, but not dominant. American living standards adjust downward. The middle class, which depended on cheap imports funded by printed dollars, shrinks. The wealth gap, already extreme, widens further. Now, here's the question everyone asks. Can this be stopped? Can America reverse the decline? Theoretically, yes. In practice, no. Reversing reserve currency decline requires four things. First, balance the government budget. Eliminate the $2 trillion annual deficit. Show the world that America can live within its means. Second, fix the trade deficit. Export more, import less, rebuild manufacturing. Third, restore confidence in the Fed. Stop printing money. Maintain price stability. Fourth, avoid weaponizing the dollar. Stop freezing reserves. Stop sanctions that force countries to build alternatives. Every one of these requires political choices that are politically impossible. Balance the budget? That means cutting Social Security, Medicare, defense. No politician survives that. Fix the trade deficit? That means accepting higher unemployment as manufacturing returns and lower consumption as imports fall. No politician chooses that. Restore Fed credibility? That means high interest rates to fight inflation even during recessions. No Fed chair survives that. Stop weaponizing the dollar? That means giving up geopolitical leverage. No president accepts that. So the decline continues. Not because Americans are lazy or stupid, because the political system cannot make the choices required to stop it. This is the same trap Britain fell into. Everyone could see the pound weakening. Everyone knew what needed to be done. But doing it required political pain that no government would accept. So they delayed, temporized, and hoped something would change. Nothing did. The pound fell anyway. The dollar will follow the same path. Slow grinding decline from 2026 to 2035. Faster decline from 2035 to 2040 as confidence breaks, and stabilization at a new lower level by 2040. Not elimination, adjustment from hyperpower to major power. From monetary hegemon to one of several important currencies. And Americans will adjust. It'll be painful. Import prices will rise. Living standards will fall. The government will struggle to fund programs. But life will continue. Just poorer. Just less dominant. Just more normal. This is what happens after the dollar loses control. Not Mad Max. Not collapse into chaos. Just Britain's path from 1914 to 1950. Compressed into 20 to 25 years because modern finance moves faster. The mechanisms are identical. The timeline is different, but the outcome is the same. The currency that dominated the world for 80 years becomes just another major currency. Important but not exceptional. 3 reserve currencies collapsed before the dollar. The pattern is clear. The stages are defined. We're in stage 6 of 8. The timeline says full transition by 2040. The only question is whether Americans understand what's coming and position accordingly, or whether they're surprised when the adjustment hits. Understanding the pattern doesn't let you escape it, but it does let you prepare. The dollar's reserve status is ending, not immediately, not catastrophically, but inevitably. And when reserve status ends, everything built on that privilege adjusts. Living standards, geopolitical power, government funding, all of it. This is the price of 80 years of monetary dominance, and America is about to pay it. If this showed you a pattern you haven't seen clearly before, if you understand now that dollar decline isn't a future threat, but a current reality, then you're starting to see what most miss. The collapse is already underway. We're just watching it in slow motion.